Hello everyone. Welcome back to Development Economics 2. As you know, we have been discussing the topic of financial instability in a globalized world. The learning objective of our today's discussion is financial instability hypothesis. If we do a recap of what we have been doing so far, it will be better for us to understand why we are doing what we are doing today. We have discussed the idea of globalization. Now remember, the main topic of our discussion is financial instability in a globalized world. Unless we understand what is globalization, we will not be able to understand the topic itself. We will not be able to contextualize the very topic itself. So therefore, we had to discuss the idea of globalization, where we have covered its meaning, its consequences, and then different episodes of globalization. And last but not the least, we had to and we have discussed the idea of liberalization of money market. And this is the part that is really relevant for our discussion, particularly for this topic. Next, if we think about, we have discussed the idea of financial instability. There we have talked about the very concept of financial instability and then kind of related and relevant issues with the idea of finance and the idea of financial instability or stability. How do we kind of measure it? How do we conceptualize it? And what are the issues to remember when we are trying to conceptualize this idea of financial instability? And we have also very briefly talked about various financial crises that we have seen so far. We have not discussed all of them. We have discussed a select set of financial crises, but we have discussed briefly so as to give an overview of their different kinds of financial crises. Now today what we are going to do is the very idea of financial instability hypothesis. Now there is a whole theory of what kind of leads to financial instability. You have to understand that there are many theories about any topic. Now in this case, we are going to talk about a very prominent idea about the financial instability, and it is famously known as financial instability hypothesis. As we go along, we'll understand the very concept of it. Now, before we enter the topic of financial instability hypothesis, we will briefly talk about the person who kind of came up with the hypothesis. It's not that he completely came out of blue or something. He also has borrowed from other thinkers, and he has also talked about them. For example, he has adapted ideas from Keynes, and he kind of theorized in his own way the idea of financial instability hypothesis. He is none other than Hyman Minsky. Now, he is considered as an American post-Keynesian economist, and he is originally from Chicago. He initially studied mathematics at the University of Chicago, but then he switched to economics, and then finally he received his PhD from Harvard University. And he has taught in these places, Carnegie, Mellon, and Brown and Barclay, and before he took up a position at the Washington University in 1965. Some of his famously known works are like John Maynard Keynes, and also he talked about this whole idea of financial instability hypothesis, and he came up with more detailed analysis of it in this particular work named as Stabilizing an Unstable Economy. So he is the man behind this main hypothesis that we're going to talk about today, financial instability hypothesis. Now he says that there are empirical aspect of it and there are theoretical aspect of this hypothesis. So let's look at the empirical aspect of financial instability hypothesis. He actually starts his argument from the very fact that historically there are different episodes of financial instability. And this also helps our discussion because we have actually talked about briefly various kinds of financial crises. Now he says that from time to time, capitalist economies exhibit inflations and debt inflations. Now, there are a couple of important points in this particular line itself. What kind of economy that we are talking about? We're talking about capitalist economies. And he's saying from time to time, which actually kind of gives us an idea that this is not a one-off event. It is more of a recurring event, right? Now, there's a recurrence of inflations and debt inflations. It's like what he argues is like a spiral. And the spiral is a very dangerous thing. Why is it a dangerous thing? See, it's like this. If A leads to B, it's not a spiral. If A leads to B, B leads to C, and C then leads back to A, then it's like a spiral and it continues, right? Now, look at this argument. There is a reaction to crisis. Suppose there is a crisis, then there's a reaction to crisis. and that leads to further crisis. Now, if you think about somebody is sad, and therefore a student is sad, let's say, because the result did not happen well, right? The exam did not go well, the result is not good, so the student is sad, and the student gets demotivated about studying. As the student gets more demotivated, she or he loses interest in studying. As that happens, then actually she does not study at all. She actually reduces, her studying time, which again leads to further deterioration of the result, which again leads back to her own depression in the process. So it's more like a vicious cycle. It's a spiral that, look at this line, there is a crisis and there is a reaction to the crisis. That itself leads to further crisis. So inflation feeds upon inflation, and debt inflation feeds upon debt inflation. Well, now whenever there is a problem in economy, you expect the government to intervene. Now, with the best of its intentions, the governments across the world they have intervened during different crises. Now, it could be the fact that the way they intervened was not the right intervention. It could be the fact that they did not kind of intervene at the right moment. But what he is arguing that even if the government tried to intervene, they have not been very successful. They have been inept in some of the historical crises. Now, these historical episodes suggest one thing, which is clearly what he argues, that economy does not always conform to the classic path that is suggested by Smith and Walra. Now, if you recall, many of you might know that Adam Smith argued about free market competition, that market mechanism is a very powerful tool, which the main argument was that leave it to the free market, things will automatically adjust to, and it will move towards stability. Same was the argument perhaps with Walra. Now, if you go back to a general equilibrium model, you'll see something similar coming up. But what he is arguing here, that's not the case, and this whole argument is based on the fact that we have historical evidences that is not the case. So what Smith and Walra implied is that economy can best be understood by assuming that it is constantly an equilibrium seeking and sustaining system. So it's like on its own, it will move towards equilibrium, as if it will look for equilibrium. There's something innate in it, like it will go towards equilibrium, and it will sustain. It is exactly opposite of what Minsky is arguing. So Minsky is arguing that's not what historical evidence suggests. Now, if you look at, therefore, based on these some of these historical evidences, which he says the empirical side of the crisis and instability, that there are enough proof of instability. So let's now talk about why we have this instability. Now, he says the financial instability hypothesis, he is not coming up entirely on his own, as he says, we also mentioned at the beginning, but he develops further on it. He says it borrowed from Keynes's main argument in general theory. Also, he refers to Joseph Schumpeter. So if we look at the the way it has developed, it's Keynes, it's Schumpeter, and also it's Hyman Minsky himself. This is where it is important to understand the context. The context is a capitalist economy with expensive capital assets and a complex and sophisticated financial system. Now, this is why we are saying this is important, that suppose we teach a model and you take that model and go and apply it on every country in the world, there is a problem. You have to understand different countries' context differently. It's like there is no one medicine that works for all kinds of disease. There's no one medicine that works for all patients in the same disease also, because the patients may have very different situation. So it is important that you understand that the situation we are talking about is a capitalist economy with expensive capital assets and a complex and sophisticated financial system. The economic problem that we are dealing with here is defined following Keynes's argument, as Minsky himself suggests, that we have a problem is the capital development of the economy. The key problem that we are facing here is a development of capital or capital accumulation in an economy, as opposed to the Knightian understanding of allocation of given resources among alternative employments. Some of these things you have learned from also microeconomics, that there's a problem of allocation. Now, Minsky says that we are dealing with a problem of capital development in our economy. This is where money plays a very important role, and we'll see that why money plays an important role. And fascinatingly, we'll see that how time, money, finance, they are all coming together. So capital development of a capitalist economy is accompanied by exchanges of present money for future money. Look at this line, exchanges of present money for future money. As we just mentioned, that there is time dimension to it, and money plays a very key role. And as if there is some sort of exchange happening between present money and future money. It will be clear the moment we proceed further. Let's go through the long quotation that appears on your screen. We'll take a closer look at what Keynes is arguing here. He is saying there is a multitude of real assets in the world which constitutes our capital wealth. For example, buildings, stocks of commodities, goods in the course of manufacture and of transport, and so forth. The nominal owners of these assets, however, have not infrequently borrowed money in order to become possessed of them. To a corresponding extent, the actual owners of wealth have claims not on the real assets, but on money. A considerable part of this financing takes place through the banking system, which interposes its guarantee between its depositors who lend it money and its borrowing customers to whom it loans money, wherewith to finance the purchase of real assets. The interposition of this veil of money, this word is important, veil of money between the real asset and the wealth owner is an especially marked characteristic of the modern world. Now, if we have to understand this whole long paragraph, let's look at some of the key points. A, that there are different kinds of capital wealth, buildings, stock of commodities, then goods in the course of manufacturing or in transport, and so forth. Now think about somebody has to make an investment, right? Somebody has to buy a machine, or somebody is buying a house, right? Now, if you have to buy a costly machine, or you have to buy a house, you might go to the bank, ask for a loan, right? Now, it's like a claim that the person who is lending you the money, the person has a claim. In this case, the bank has a claim on the asset that you are purchasing. More about the value of the asset that you are purchasing. What will become the value of the asset in future? The bank has a claim over it. In a funny way, if you think that if you are borrowing money from the bank, on paper you own the house, and which you have bought, taking this home loan. But then if you're not able to pay back the loan, the bank takes the house, right? Now, think about it this way. So a considerable part of this financing takes place through the banking system, which interposes its guarantee. There's a guarantee that we are talking about between its depositors, the people who are depositing the money in the bank, and therefore who are lending the money, and its borrowing customers, those who are borrowing the money. Okay, now let's pause for a minute and let's take a simple question here. Give some examples of capital wealth. Okay, we have discussed of various kinds of examples of capital wealth, like houses, the machines, the capital stock itself, the goods in the process of manufacturing or in transport, and so on. So there are various examples of capital wealth. Now we are coming to this idea of financial contracts and time. This is where it gets very interesting. Let's look at this picture on your screen. The Keynes veil that we talked about implies that money is connected with financing through time. Time is a very important thing here. Let's look at the process. There are depositors who deposit their money in the bank. Then the bank takes the money, then they loan it to somebody else. Let's say the firms are trying to purchase some machines, they're taking loan. So the money flows in this following way. Look at the upper part of the chart. From depositors to banks to firms. After a certain period of time, the borrowers are supposed to pay back the money. So the movement is in the opposite direction. You can see the lower part of the picture. From firms to banks and then to depositors. But what is happening between these two flow of money? The upper part, which is the upper flow from depositors, bank to firms, and then firms to banks to depositors. Something is happening in between these two kind of flow of money, which is time. There's a time gap between these two events. Now, finance and time. So the idea is that you take the money at some point, there's a promise that you will pay back the money at certain point, right? And these two flows happen with a time gap in between. Now, the exchanges are for the financing of investment, and subsequently, the exchanges fulfill the prior commitments which are stated in the financing contract. What does the contract say? The contract says, I'm borrowing the money from you, I'll pay back the money. Now, the first exchange that is happening here, there's a financing of investment. Okay, you are trying to buy a machine, there is a financing for that investment, but then subsequently you have to pay back the money. So the flow of money to firms is a response to expectations of future profit. Why is the bank or the depositors they are lending money to the firms? Because there is some sort of expectations that there'll be profit in the future from which they'll get back their money. So there's some sort of expectations about future profit, because you're saying, okay, I'm going to buy a machine for which I need some money, right? I need the financing. Now the person who is giving the loan, or the bank in this case giving the loan, the person would hope that the business runs and there is a profit. Suppose you go and say that, okay, I'm starting a business which may not run. Do you think you'll get the loan? You will not get the loan. So of course, when somebody is giving you the loan and you are borrowing the money, there is this expectations that there will be some profit in future. The flow of money now from firm is financed by profit that are realized. Now in these two lines, there's a crucial thing that we're talking about. A, there's an expectations about the future profits, and so you are giving the money because there's an expectation about future profit, and the money is being paid back because after you have actually realized the profit, once you actually have the profit. So thus in a capitalist economy, the past, the present, and the future, think about it, the past, present, and the future, they are linked by not only by capital assets and labor force characteristics, but also by financial relations. So what is the role that business expectations play here? Expectations of business profits determine both the flow of financing contracts to business and the market price of existing financing contracts. Now, suppose, for example, somebody is giving you a loan, and there is a high chance that the business will really run very well, right? Now, based on that, the person may agree to give you a good loan at some, reasonable rate, because they know that, you'll make some good money and they'll get back the, loan. Suppose you're saying, okay, it's kind of risky venture. The person may still give you loan, may not be that much amount, but then the rate of interest might also be high. Also, it's like suppose the bank is giving you a home loan, right? You're saying, okay, I am purchasing a home, I need some loan, the bank is giving you loan. And what is happening in the minds of the bankers? They are thinking, okay, I am giving the loan, there's a mortgage that you keep with the bank. This fellow cannot pay back the money, the house becomes, the bank becomes the owner of the house. Think about it. If the housing market is not doing well, which means if the banks somehow think the housing prices are not going to rise so much, would they really like to give so much loan? They may not, right? Now, how they value the financial, the very contract, the asset that you're going to talk about, how much loan they're going to give out, it all, is connected with the profits that you're going to make in the future. In this case, particularly the asset we just talked about, which is home, how the value of the asset is going to appreciate. Now, profit realizations, on the other hand, determine whether the commitments in financial contracts are fulfilled. So, profit realizations will actually determine the commitment that you have made in the contract, that I will pay you back the money. Well, of course, you will pay back the money only if the expected profit you had, okay, I'm going to make this much of money, only if you realize that. That means when actually it happens, then you can pay back the money. Now, whether financial aspects perform as the proformas indicated by the negotiation. Okay, now there are other players also, and therefore there's a growing complexities. Now, if you think of, we just showed that chart where firms are the main borrower of the money. The financing is not happening only for the firms. We also have households, we also have governments, right? We also have international units. Why for households also we have? Because by their way of their ability to borrow on credit cards for big ticket consumer goods, or such as automobiles or their house purchases, right? And to carry financial assets. Similarly, governments also have some requirement, they can also borrow money. International units are also there. So an increasing complexity of the financial structure in connection with a greater involvement of government as refinancing agents for financial institutions as well as ordinary business firms, both of which are marked characteristics of the modern world. The involvements of all these players can actually make the system more complicated and complex, right? And also the role of the government as a refinancing agent in the whole process. But whether it's a simpler system or a complex system, something remains as it is, which is the level of profits. That is the key determinant of the system behavior. And also there's an importance of structure of aggregate demand, because there's an expectation about future profit on the basis of which there's the first flow from the depositor through the bank to the firms who are borrowing the money. Based on the realization of the actual profit, there's the other flow from the firms to the banks, and then the depositors get back their money, right? Now, why there's this importance of aggregate demand or the structure of aggregate demand? Because unless the demand side is ensured, you have to understand, this is a Keynesian argument that we are following here. Unless the demand side is ensured, the economy does not have a good future, right? Now, therefore, we have made that line bold. Investment takes place now as in present, because businessmen and their bankers expect investment to take place in the future. Now, look at this very important line, that you are deciding today to make an investment because you think that tomorrow will be a good tomorrow, that the future is good, which means even tomorrow there will be further investment. So investment takes place now because businessmen and also the bankers, not just businessmen, because they need money. The bank has to loan the money, get the loan, right? So both the parties have to have a good expectations about future. So both the businessmen and their bankers, they expect investment to take place in the future. Now you see the bank is like a central thing in the whole story, right? And we're saying bank matters. Why? Now you have to understand bank as a profit-seeking activity. Banking is a profit-seeking activity, and bank seeks profit by financing activity and bankers. Bankers know how they would innovate, how different innovations would assure, profit. So there are different kinds of financial assets. And every now and then you'll see the bank is coming up with new policies, some new financial instrument and so on. There'll be a lot of advertisements about various kinds of options. You can take this kind of loan, that kind of loan, and they actually keep innovating these different financial instruments so as to make profit. Now, bankers in this case are merchants of debt who strive to innovate in the assets they acquire and the liabilities that they make. So in understanding the whole story, we have talked about the idea of time and how kind of finance links that past, present, future, and also we are highlighting the role of the bank in the whole process. So we come to this point, the financial instability hypothesis, therefore, is a theory of the impact of debt on system behavior, and also it incorporates the manner in which the debt is validated. A question for you here. How business expectations are important? Now you understand the business expectations are important in many ways, both from the sides of the firms who are actually borrowing the money and also the banks or depositors who are lending the money. Unless they have a good expectation about future, they'll not lend the money. Unless the firms also have a good expectation about future profit, they'll also not borrow the money. And when that expectation is realized, the things are fine. Okay, now we'll talk about three different kinds of income-debt relations, which is kind of key also, is the last step to understanding the main financial instability hypothesis. We are talking about hedge financing units. Hedge financing units are those which can actually fulfill all of their contractual payment obligations by their cash flows. Business going good, right? So if there are three different kinds of financial units that we're going to talk about. The first is the hedge financing units. It is that kind of units where you can pay back the money from the basis of your actual cash flow that you're doing the business, everything is fine. The greater the weight of equity financing in the liability structure, the greater the likelihood that the unit is a hedge financing unit. From the very structure of it, from the very definition of it, you can understand that hedge financing unit will be a more secure kind of scenario, right? If you have more of hedge financing units, it's better. Think about it, it's a very simple thing, because if you say that these are those units which can fulfill their contractual payment or their commitment, right, by their own cash flow. It's a good thing, right? On the contrary, let's go to the next one. I think it will be better to understand then. The speculative finance units. So speculative finance units are those units that can meet their payment commitments on income account on their liabilities, even as they cannot repay the principal out of their income cash flows. Now compare it with the previous one. In the previous one, both the interest as well as principal could be paid out from their actual income. But in the second case, in the speculative finance unit, you are perhaps able to pay back the interest but not you don't have enough income to pay back the principal. So what you might do, that's written in the next paragraph, by the way, that such units need to roll over their liabilities, which is issue new debt to meet commitments on maturing debt. It is as simple as this. You take new loans to pay back the principal of the previous loan. Because the previous loan, the interest payment of the previous loan, you could manage from your income. But the principal you could not manage. But then you have to pay back. How do you pay back? You take the next loan. Why are you taking the next loan? To do something good? No, not exactly. You are taking the next loan because you have to pay back the previous loan's principal amount. Now, you can compare easily with the previous financing unit. That we are getting into a little more risky and tensed area here, right? Now we go to the third one, which is the most dangerous and problematic of all, which is Ponzi units. For Ponzi units, the cash flows from operations are not sufficient enough to fulfill either the repayment of principal or the interest. At least in the second case, you could pay back the interest. And for principal, you had to kind of borrow money. In this case, you are neither able to pay principal nor able to pay the interest payment also. Because, so what we are saying here is that for Ponzi units, the cash flows from operations are not sufficient to fulfill either the repayment of principal or the interest due on outstanding debts by their cash flow from operations. From whatever things you are doing, you do not have enough cash inflow so as to pay back both the principal as well as interest. Now, this is a very tricky situation, as you understand, because such units can sell their assets or borrow. And in this case, you are not borrowing like the previous case, just borrowing to pay the principal. You are borrowing even to pay back the interest that you have to pay back. So you understand this is a very, very risky scenario. So you are borrowing to pay interest or selling assets to pay interest. And even dividends on common stock lowers the equity of a unit. So such units can sell assets or borrowing to pay interest or selling assets to pay interest on common stock that lowers the equity of a unit. Now, a unit that Ponzi finances lowers the margin of safety that it offers the holder of its debts, clearly. Now, if you just compare the three, the first one is those kinds of unit where you are able to pay back both the principal and the interest rate in a comfortable way because you have enough income to pay back both. The second one, you are able to manage to pay back the interest but not the principal. So you take new loan, you kind of roll over, right? You issue new debt so as to pay back the principal of the previous debt. And then the third one, where your operation is such that you don't have enough inflow, as an inflow of cash, that you can pay back interest also. Forget about paying back the principal. So in this situation, you might have to sell the existing assets that you have so as to pay back. Now, you understand of all three, the last one is the more dangerous. Both the second and third one, the more you have the first one is better for the economy. Now, we are asking a simple question here. Take a moment and answer this. Think about this question, that what are hedge financing units? We have discussed about this, and you can easily answer this question if you go back to the definitions of these three kinds of units that we just talked about. We are leaving it up to you. Now, why does this, we are coming to the final few parts of our discussion today. Why does such characterization matter? Because it can be argued or it can be shown that if hedge financing dominates, then the economy may well be an equilibrium seeking and containing system. Remember Smith-Walra? If the system has more of hedge financing in units, then perhaps you can say that the system has like a tendency, it's seeking equilibrium and kind of containing the system. In contrast, if there is a greater weight of the speculative or Ponzi scheme or Ponzi finance, in this case, the greater the likelihood that the economy is deviation, there is a deviation, and that the economy is a deviation amplifying system. Look at this fantastic expression. Deviation amplifying system. Suppose there is an equilibrium here. it's not a deviation alone. It's a deviation that is being amplified, that is being increased. There's an increasing divergence from equilibrium. So if you have more of Ponzi and the speculative kind of unit, the system becomes more of a deviation amplifying system. The economy becomes that kind. Now we are coming to two main hypotheses here. One, the first theorem, there are two theorems of the hypothesis. The first theorem of the financial instability hypothesis is that the economy has financing regimes. So there are different kinds of financing regimes under which it is stable, and under other kinds of financing regimes it is unstable, right? So there are different kinds of financing regimes. This is important to understand because an economy can pass through different kinds of financing regimes, which one regime could be more stable, the other may not be that stable. The second theorem of the financial instability hypothesis is that over periods of prolonged prosperity, the economy transits from financial relations that makes for a stable system to financial relations that make for an unstable system. What we are saying here? That over time, there is some sort of automatic mechanisms that you kind of the economy transit from a finance relations that are more stable in nature to a finance relation system where things are not so stable. So in particular, over a protracted period of good times, capitalist economy tend to move from a financial structure dominated by hedge finance units. You move from a situation where you're dominated by hedge finance units towards more of the other two kind of finance units. So towards the end, what we are saying is the financial instability hypothesis is a model of a capitalist economy which does not rely upon exogenous shocks. You don't need exogenous shocks. You have enough things inbuilt in the system. There's an inbuilt crisis, tendency towards crisis. So the initial internal dynamics of capitalist economies and the system of interventions and regulations that are designed to keep the economy operating within reasonable bounds, these two play important role. There is something inbuilt in the process that leads to a crisis. So what is the conclusion? We have talked about the main thesis here, a hypothesis that, by Hyman Minsky, and we say that the central problem of capitalist economy about the capital development, and we discuss the role of time and financing and the link between these two, how finance kind of connects through different time periods like past, present, future. What is the role of business expectations in the process, the role of banks, and the different kind of income-debt relationship. Finally, we came up with the two theorems we talked about. So the bottom line of the whole story is that the internal dynamics of capitalism leads to the instability without any exogenous shock. That is the main key point to take home. Thank you.